Welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Mark Kimbrough.
Hey, yo.
Mark, it's 10 a.m. Pacific time here, February 7th. I hope all of our listeners are staying healthy out there. And I know there's a kind of a bug going around. Everyone in my household is sick, and the rainy weather probably not helping lift their spirits these days.
Good luck to all them. I've been feeling a little bit too. I hear you.
Yeah, but obviously the rain's much needed here in Southern California, so we'll take it, but the dreariness just gets to me. With that, let's move on to the where are we for the week. If we look at the S&P, I'll call it flat. I show up around 8 basis points right now, so we'll call it flat on the week. Here, looks like the biggest loser is consumer discretionary, down, call it 2.25%. The other big loser is industrial, is down half a percent. Looks like the big winner, we'll call energy up almost 2%, tech's up 1 and change, and financials are up a percent. So that's kind of the big mix here. If we look on a year-to-date basis, though, S&P up almost 3%, comm services and healthcare, the big winners, up almost 7. Oh no, financials up 7.5. So that is a pretty good mix there. No sectors negative on a month to date or on a year-to-date basis here yet. If we look at the Russell 1000, that's flat, so kind of in line there with S&P. Russell 2000 down about 20 basis points or so. So small caps are underperforming a little bit. Growth and value performed in line with each other, both flat on the week, and the S&P equal weight down about 80 basis points on a week-to-date basis. But green across the board on the year-to-date. Some misses there on a week-to-date basis. If we shift our focus over to the bond market here, we did get a little bit of a rally in the interest rates. The 10 years down to 4.5. I was looking at the screen right now. The ask is 4.499. So we'll call that. That's down about 4 basis points on the week. The long bond down to 470. That's in by 9 basis points. But the 2 years up, actually, it's up 2 years up to 428, up 8 basis points on the week. So a little bit of a curve flattening that happened here on a week-to-date basis. That how does that translate to your returns? The ag's up 1/4 point or so. Treasury's up 1/4 point. Agency mortgages up 40 basis points. And investment grade corporates are up 1/4 point. So pretty much in line there from the more traditional fixed income sectors. Surprisingly, high yield and bank loans actually negative. Well, I guess if we'll call it S&P up 8 basis points flat, we'll call high yield down 8 basis points. I'll call that flat too. I won't be negative there on the high yield and the bank loan side of things. EM up 1/4 point. So not too much movement from the fixed income indices. Still looking at almost a 1% return here on a year-to-date basis from agency mortgages. High yield up 1.25, EM up 1.5. So there have been some pockets of opportunity in the fixed income markets.
I was going to say, it was a nice week this week up until today, when we had this little bounce following what we'll cover later today. But
yeah, I was looking at it. Yeah, it was a bounce today, up 7 bips. The 10 years up 7 bips so far today, but put in a pretty good rally there on Wednesday, down 9 basis points. Commodities positive on the week, up 2%. The winner is industrial metals, up 4. Energy's up 2.5. Like the only negative sector, down almost 1% there. WTI crude down 2%. We're looking at $71 per barrel of WTI right now. And gold, Kimbrough, your favorite assets, up almost 2% on the week, up 8.5% on a year-to-date basis so far at $28.63. So some pretty big moves there from the precious metal side of things. I guess precious metals up 1.16, so silver lagged a little bit there.
It's still shining.
Still shining. I guess that's why everyone likes it, because it's a shiny rock, as Sherman likes to say.
It's not that different from a fishing lure.
Well, hopefully, Kimbrough, the gold bugs out there have larger brains than the fish.
That was in jest.
With that, let's go on to the macro calendar.
All right, pretty busy week this week. This was jobs week. I pull this up real quick. Apparently didn't have it. But we'll start off with Monday. We had ISM manufacturing, so not jobs, but I'll still mention something about employment in there. This printed 50.9. This was 0.9% above estimates and 1.7 above the prior. We're going to temporarily at least ring a bell and say 26-month streak of prints below 50 now comes to an end in January. I truly hope that doesn't get revised away next month. But, hey, we've been calling for, or waiting patiently for manufacturing to return. So I'm going to mention a couple of the components within this report. I'll start with demand. We had new orders that increased by 3 points to 55.1. Actually, in the December report is interesting. It was the first time we had back-to-back expansionary prints, so prints above 50 for this new orders metric. It was the first time since the May-June period of 2022. Well, we've now extended that to 3 months, and hopefully that can continue. We now have 3 months of expansion for new orders. Hopefully to support that, one of the other metrics here is the customers' inventories, the customers of the manufacturers. That is printing sub 50. It reflects an assessment the customers are saying their inventory is too low. So hopefully that's can be a potential tailwind for new orders in the future. In line with a pickup in demand, we had production and employment both return to expansion. Production, I'll leave it there. They both returned to expansion. We'll take that as a plus. Lastly, the prices metric rose 2.4 points to 54.9. You know what? Pretty much in line with what we've seen for the past year for this metric. But if we do have a sustained increase in new orders, it'll be interesting to see how the prices here respond. Moving forward, we had the SLOOS report also on Monday, the Senior Loan Office Opinion Survey on bank lending practices. High-level summary of this, I'll call it a mixed report, but in general, bank standards are tightening, and you can say demand is mixed. If I just pick C&I loans for businesses, again, the standards tighten across the board for firms of all sizes, but demand was noted to be a little stronger on net for the larger and middle market firms. Not too, for the most part, the report was relatively mixed. I think the biggest takeaway, standards are slightly tightened, but that didn't completely turn demand the other way. Speaking to Tuesday, we have our first jobs number. We have the JOLTS job openings for December. This printed 7.6 million. That was 400K below estimates and 556K below the prior. JOLTS has been in a downtrend since March of 2022 when it was north of 12 million. But now, this decline, it brings the ratio of the openings to unemployed down to 1.10 versus a prior of 1.14. Not all that bad. This is still above the September local low. But I do want to say, after 2 months of improvement in JOLTS, we did have 2 upticks. We were due for a step back. We haven't had 3 months of consecutive increases since back in 2021.
And I think Powell was the one who was talking about how they kind of wanted it back in balance. It was his phrase I think he used, and it was wanted to get to a 1-to-1 ratio. So even though we're up a little bit from the low of 107 or down from the 114, it's still in that one. I call that that's right in the range there for the Fed.
We're in the context of where we were, pre-COVID. So we're returning back to normal. Yeah, maybe we're still a little room to grow, but drastically different than we saw north of 2 at one point. There were, two openings for every person out there looking. So definitely more of a normalized labor market. Moving forward to Wednesday, we have the ADP employment change report for January. This printed 183K. It was 33K above estimates and 7K above the prior. No reason to dig into this too much other than I'll say the service providing jobs, all the service jobs saw growth on net, plus 190K, and the loss came out of the goods producing sector. That was 6K with all the losses focused in the manufacturing sector. So we'll see how that, again, that's ADP. We try and, it's supposed to be an early look to the NFP, but we instead just wait for the NFP. On Wednesday, also, we had the ISM Services Index for January. I'm going to talk about this maybe a little more than I normally would, but I thought this was a super interesting report. It printed 52.8. That was 1.2 points below the estimates and the prior. So new year, I want to give this in context, some of these numbers in the context of 2024. The average print for this headline index was the average print in 2024 was 52.4. We printed 52.8. We're in the context at the high level, you'd say, hey, that sounds pretty good. But under the hood, the details to me looked at least a little more concerning. We're still in expansion territory, but there were some points to note. The headline metric is a simple average of 4 components. There's 10 components, I believe, in the index, but you have new orders, business activity and production, employment, and supplier deliveries. So I want to talk on each of those as well as a nod to prices later on. The new orders metric, that averaged 54.0 in 2024. We got a print of 51.3 in January. Still expansionary, but that is the second lowest print we've seen in the last 2 years. New orders is, that's tip of the spear for demand, for all of services. That is demand. If you don't have demand, you don't have anything. But you know what? I'll say, not to overemphasize that, we're in expansion. So it is still good, even if it's relatively weak compared to how strong it was last year. But moving forward, we'll do business activity and production. That was very firm, as we know, for 2024. The services economy was booming. We're still continuing to tick along. That averaged 55.7 versus a print of 54.5. I'll call that steady as she drifts right there. It would help if you had new orders pick up a little bit, back to that elevated territory. But, it's still positive. But there's one metric that it was interesting that I actually stumbled across this morning. The backlog of orders metric. When your activity and production is high, you're working through your backlogs if you're not having that being refilled by new demand. Well, the backlog of orders metric has now been in contraction, so sub 50, for 6 consecutive months. And I noticed, we got data going back to 1997, that's only happened 4 times. I'm going to quote a couple of years for you, and this is when it hit the 6-month mark. It happened in 2001, when we had a 16th month streak of contraction. The 6-month period would hit 2001, so it continued in 2002. It happened again in 2008. We had a 7th month string of contraction for this metric. Again in 2009, we had a 13-month streak. And here we are on month 6 in 2025. So again, not saying that's predictive, but it's an observation I want to point out. We also have the employment metric, averaged 49.2 in 2024. We got an expansionary print of 52.3 this month for January. So, they called that a win. We ended 2024 on a high note. All of the Q4 prints were in expansion territory. So we're just continuing on with that. Lastly, supplier deliveries. That averaged 50.7 in 2024 versus a print of 53 in Jan. Expansion for supplier deliveries indicates slower deliveries, which is something you expect when you're having rising demand. People are kind of struggling to keep up with that demand. So, even though it was a relatively low print, even though it's 53 is a good print. So I'm just going to say that's supportive of expansion. Lastly, we had the prices metric, again, not part of the headline calculation, but in 2024, that averaged 58.7 versus we had a very strong 60.4 print in January. We're rooting for disinflation services, but this still is persistently high. Thanks for bearing with me through that whole report there. On Thursday, we had the initial jobless claims for the week ending February 1st. Steady as she drifts here. Printed 219K. That was 6K above the estimates, 11K above the prior. And the continuing claims for the week ending January 25th, that printed 1.886 million. That was 16K above estimates, 36K above the prior. Just going to call that steady as she drifts. We're keeping below that 1.9 million, kind of high local watermark for continuing claims. And that brings us to today. We had annual revisions to the establishment service survey data. So that is non-farm payrolls. Brief summarization of that. The average monthly print for 2024 was revised down from 186K per month to 166K per month. I found it interesting, though. It was 8 of the 12 months were revised down, but the final 3 months were all revised up. So just like I said on the other report, we ended the year on a high note when it came to employment, which moves us forward to the actual non-farm payrolls report. Not the strongest of prints today. We had 143K versus estimates of 175K, so that's 32K lower, and 164K lower than the prior. That sounds like a large month-over-month change, but that has to do with revisions. We had 2-month net revisions of 100K, plus 100K. You know what? One more point to mention. I want to say, Ryan Kimmel, you pointed me this direction this morning. It's interesting to note we have the 3-month moving average of the non-farm payrolls is now at 237K. I know you were talking private, but I'm going to use the headline. This is the highest level we've seen for this 3-month moving average since March of 2023. So again, reemphasizing, we're kind of at a local high note. So we'll wrap that up with the establishment report and move on to the household survey, which is the U3 rate for January. That printed 4.0%, 0.1 below the estimates and the prior. The labor force participation rate came out at 62.6%. That was 0.1% above estimates and the prior. And lastly, the underemployment rate, that's the U6 rate, came out at 7.5%, right in line with the prior. Look, within the report is actually interesting. The BLS refused to give you month-over-month changes from January to December because it would be very disingenuous to do so if you just stated those numbers because of the revisions that took place for January. They have new updated population controls that started effective January. So in general, the BLS characterized the report. They said if you were to adjust the December print the same way you adjusted January, you would see, call it let's see, the unemployed people, the number of unemployed, the number of long-term unemployed, the labor participation rates were all, call it little change to unchanged month over month. So we'll call it kind of a steady she drifts and attribute a lot of these movements to revisions or the new population figures.
Yeah, we've been talking about for a long time, Kimbrough, how that there's then that divergence, right, between the establishment survey and the household survey, and all the bears were talking about how it was the established one that was too high, and the household one was the more accurate one. But with this revision, it's actually the household that's popped up and looks close that gap pretty significantly.
Yeah,
so it's pretty interesting that one of the things the bears have been pointing to actually turned out to be other way around, bro.
Yeah, other way around, bro, indeed. Last thing I'll mention on this report actually is just giving a nod to, nice to have the rain here. The BLS did mention about the fires going on in SoCal, as well as severe winter weather around the country. And just they wanted to highlight that those events didn't have any impact on their ability to provide these results. That basically the samples are out there surveying were within the normal range. It's not to say those didn't have impacts on the actual number of jobs, just their ability to provide these numbers to us. We're not impacted. So they feel confident in their estimates. Lastly, we have the University of Michigan sentiment report. Look, I usually don't dig too deep into these numbers. I'm not going to today, but I'm going to give you a high level. The sentiment numbers all declined. The current conditions, expectations all declined, and we had a significant rise in the one-year inflation expectations from 3.3 to 4.3%. In the report, they briefly mentioned, they attributed this to tariffs. I'm going to say that these numbers can whip around wildly. This 4.3% is the highest we've seen since November of 2023, when we saw 4.5%. But in December of 23, this dropped a whopping 1.4% month over month. So we're right back down to 3.1%. So I will not overemphasize the spike in this one-year inflation metric. But the 5 to 10-year inflation metric did jump to kind of broke out of its range and hit 3.3%. Versus a prior estimate of 3.2. Only mentioning that because once upon a time, Powell did make reference to it, so we do keep an eye on it. That's the highest this metric has been since June of 2008, when it was at 3.4%. So just, fun facts there, but we don't put a whole lot of stock in that. Just that 5 to 10 is nice to keep an eye on. And that wraps up the week. We got a report later today, but it's not released. That's consumer credit. That'll be released at noon Pacific time.
Yep. Thank you for that extensive overview or deep dive. It was a busy week and a lot of jobs information, and labor market continues to be a very, obviously, one half of the Fed's mandate. So it's something that we always want to keep a very close eye on. And then, to front run ourselves, next week's inflation week. So we got to keep an eye on that other side of things also. Given kind of the macro outlook that we did get this week, the interest rate probabilities actually shifted pretty significantly here. We're down to 1.5 Fed cuts this year in 2025, and the first Fed cut got pushed, or 100% probability of a Fed cut got pushed out to September from June. So if you look at it today, it's like a 6% chance of a cut in March, an additional 23% in May, another additional 33% in June. So June, you're kind of up to like 63-ish% chances of a cut. So I guess better than 50-50, but you don't get 100% until the September 17th meeting. So it'll be interesting to see how these things shake out. Obviously, you get some inflation data that can shift, we'll shift these probabilities. You see how, obviously, a long time before we get to June or September, we have a lot more data points there. But that's really what the market's thinking now, more in line with less cuts versus more. And then, as I mentioned, next week is inflation week. Really start off with we'll get more annual revisions to CPI. We'll get those on Wednesday. So we'll have to we'll do a deep dive there next week on really what that means here. But we're looking at a inflation headline CPI of 0.3%, down from 0.4. Core CPI at 0.3, up from 0.2. That would leave the year-over-year numbers unchanged at 2.9 for headline and 3.2 for core CPI. So maybe not too much progress going on there on the inflation front, but at least it's not going up. We'll get revisions to PPI on Thursday. PPI final demand month over month for January is expected to be flat from last month at 0.2. PPI ex food and energy up from a 0.0 to a 0.3. And then year over year final demand would be 3.2, down from 3.3. And we had a bad PPI number, or a high PPI print last year at this time. So the 0.3 number would actually lead to a lower year over year ex food and energy PPI at 3.3%. Well, obviously, we get jobless claims. We'll kind of see how those shake out, and whether the California numbers kind of more normalize or continue on their trend. And then Friday, we get retail sales. The advanced month over month number is expected to be flat, down from 0.4. If we exclude autos and gas, it's expected to be up 0.3. It was a 0.4 last month. And then the control group that goes into the GDP number expected to be a positive 0.4, down from a positive 0.7. And Mark, you didn't highlight this, but we also get import prices on Friday. Import price month over month expected to be 0.4, up from 0.1%. So inflation week all around every week or every day, pretty much. In the latter half of the week, we'll get some important inflation information, and we'll kind of see how things shake out here.
Wind up week. It's like the back-to-back employment and inflation weeks really are entertaining and really comprehensive, economic data.
Yeah, and then we can relax for the latter half of the month because all the kind of big moves, or the big market moving macro events, we should be out of there. We'll see, though. The market has also tended to react a lot to tariff talk and whether there's going to be a trade war. So that's always another potential volatility point.
For sure, that is. We seem like we're moving into that period of increased volatility to whatever. Yeah, we're going to leave that alone.
Yep, exactly. All right, well, that wraps it up for this week. Mark, I was looking this morning, and the last 3 Super Bowls were won by 3 points. So if I was going to give you a choice, would you think that the Super Bowl is going to be won by 3 points by either team?
I'm going to say yes. If you're going to ask me a binary, I give you a yes. That's going to be a 1-score game, and we all know we all can guess what we think is the most likely outcome there.
All right. I'm not going to ask you to pick sides.
Nope.
So,
no jinx.
I don't want you to get called out next week from
you.
Either Kansas City fans or Philly fans.
Let's root for a good game. Have fun this Sunday.
That's right. So thanks everyone for tuning in.
Yes, thanks to our listeners out there on DL Minutes. Hit us up on the X at DL Minutes, or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Our website is doubleline.com. Our YouTube channel is youtube.com/doubleline capital. Don't forget the Roundtable Prime is up on the YouTubes. I know one of our guys was watching it this week in the office. And it's obviously very useful information. And those of you that don't want to take as much time, you can actually speed it up on YouTube, and you can watch Jeff Sherman kind of flail around in super speed. It's kind of fun.
Definitely enjoyed this.
Yeah. All right. Thanks for tuning in. Have a great weekend, and have hopefully a good Super Bowl.
Yeah. Thanks all. Stay safe out there.